In the previous video, I looked at debt financing, and I've skipped over two lessons which are on future value and present value, and bonds. And while I've skipped past them, if you have a desire or know that you're going into finance or accounting, and you'll be doing it in university or college, it is strongly recommended that you review those slides, as you'll definitely be doing present value and future value in those courses. It is a strong basis for corporate finance. That being said, moving forward, we're going to look at cash flow statements in this lesson. So let's just have a quick review. I encourage you to pause and answer these questions. What are the two methods or bases of accounting? And what is the difference between the two methods or basis of accounting? Well, the two would be accrual and cash basis. What's the difference? Well, accrual attempts to try and match the revenues and expenses to the periods in which they are earned or incurred, whereas cash basis only records transactions when cash is exchanged. So here's a little more information as we go through. There's a new statement that we learned about. We've learned balance sheets, we've learned income statements, owner's equity statements, but there's also a cash flow statement. This gives information about the cash receipts, cash payments, and the net change in cash during a period. So here's some classifications of the cash flows, and we're going to expand on this in the next set of slides. Operating, investing, and financial activities, so O, I, or F. So before we get to the classification, let's just take a look. Accrual. In the accrual basis of accounting, it attempts to create more accurate financial statements by recognizing revenue within the periods that they are earned and matching expenses to those revenues. So when we take a look at this, we think about a company which ends up producing maybe large items and they end up getting money over time. An airplane manufacturer would be an example of something like that, where they produce, and not every company has the ability to buy that asset outright. So they have a lot of accruals in terms of the money that they make over time. The net income usually doesn't equal the net cash flow. On the other side, we have cash. The transactions involving the exchange of cash only are recorded. Net income usually equals the net cash flow. With the accrual, the net income doesn't usually equal the net cash flow. So what's the purpose of a cash flow statement? It gives information about the ability to generate future cash flows, the ability to pay dividends and meet obligations. It gives information about investing and financing transactions, and it also shows the difference between net income and cash provided or used by operations. So let's go back to the idea of the classifications. So here are the three classifications for the activities. Operating activities could be income statement items and changes in non-cash working capital accounts. By the way, on the next set of slides, you're going to have some it's not true false. You're going to have to categorize a set of transactions and identify whether or not the cash account goes up or down. And you're going to be classifying them by O, I, or F. So it's going to be important that you understand these three different activities. The second activity is the investing activity. This involves changes in long-term assets and accounts. So, for example, a purchase of something like land or building would be considered an investing activity. The sale of a fixed asset, loan, or paying loan interest could also be something that is an investing activity. Financing activities involve changes in long-term liability and equity accounts. So you're going to want to keep track of whether or not these are long-term liabilities, equities, long-term assets, or technically items that are income statement items. So these are all, we're going to classify them based upon these three things. Financing activities, changes in long-term liability and equity accounts, perhaps a gain or loss on the issue or repurchase of shares, cash dividends, and long-term debt such as bonds. So let's go ahead and take a look at a little bit more. Significant non-cash activities. So this is what gets covered in accrued basis of accounting, whereas cash basis wouldn't. The issue of debt to purchase assets wouldn't be covered or wouldn't be journalized in a cash basis. Issue of common shares to purchase assets. The conversion of debt or preferred shares to common shares. And the exchange of fixed assets. These are things, again, emphasizing that they are not seen on cash flow statements. So here's where we get into that activity. Identify each transaction if the cash increases with a plus or decreases with a minus, and classify each transaction as operating, investing, financing, or none. I encourage you to pause at this point to at least go through these, and if you're not writing it down, at least do it mentally to try and identify whether it goes up or down for the cash position and the classification. Now that you've had a chance to try and go through these set of slides, we're going to take a look at the answers. So let's take a look. A repayment of a bank loan, that will definitely be a decrease, and classification, it involves a long-term liability. This will be a financing activity. Second one, we sell land for cash. That increases the position. The classification, well, it's a long-term asset, which means it's an investing activity. Reacquisition of common shares. This is an equity account. We're reacquiring, so we're buying them back, which means this is negative and that this will be a financing activity. A purchase of an available for sale investment. Well, this will end up decreasing our cash. We're getting more investment, so this will be I. The acquisition of a building by an issue of common shares. Nothing has changed because this is issuing shares. So there's no change here. The classification doesn't matter. None. An issue of preferred shares for cash. Well, we're getting cash, so that's positive here. And this affects our equity account, so it's going to be our financing activities. The distribution of a previously declared stock dividend. Well, it's a stock dividend, so there's no effect here. It means that there's no class. A collection of accounts receivable. Well, yeah, that's good. We got money, that's a plus, and that's an operating activity or class. The recording of amortization expense, well, that will end up being, well, none, because it doesn't involve any kind of cash being exchanged. That's an accrual basis. Lastly, the payment of a cash dividend. Well, that's a negative here, and it will end up being a financial classification since it's an equity account. Let's take a look at our answers. So hopefully you've got them right, along with the explanation. That takes care of the final lesson for this course. If you have any questions, as usual, reach out to me on Google Classroom or by email. Enjoy for now.